Why are there not more people talking about the $57 billion threat lurking in U.S. banks? Imagine a bomb ticking away unnoticed. It's not a physical bomb, but a financial one. This bomb sits in the heart of the U.S. banking system and is valued at a staggering $57 billion. These are unrealized losses hidden within the balance sheets of American banks. They represent a ticking time bomb, and if it explodes, it could have devastating consequences for every American. These losses stem from a dangerous combination of factors. Interest rates are rising and banks are holding assets purchased when rates were at historic lows. The value of these assets has plummeted, creating a chasm between what banks paid and what they're actually worth. This gap is the unrealized loss, and it's growing larger by the day. The danger is real and the stakes are high. We've seen this movie before in 2008. Back then, hidden losses on mortgage-backed securities triggered a global financial meltdown. Are we headed for a repeat performance? To understand the potential fallout, we need to delve deeper into the forces at play. Financial analysts are working tirelessly to predict the potential impact of these unrealized losses. They are examining historical data, comparing past trends with current market conditions. The Federal Reserve is also closely monitoring the situation, aware of the delicate balance they must maintain. Officials are debating whether to intervene and how best to do so without causing further instability. Meanwhile, everyday Americans are largely unaware of the looming threat. Families are focused on their own financial struggles, unaware that the stability of their banks could be at risk. Small business owners, too, are vulnerable, as they rely on these banks for loans and financial services. If the situation worsens, we could see a run on banks, with people rushing to withdraw their money. This has happened before, during the Great Depression, and the consequences were catastrophic. Today, banks have more security measures in place, but the risk remains. Financial experts are proposing various solutions to mitigate the risk. Some suggest government bailouts, while others advocate for stricter regulations. Opinions are divided and the debate is ongoing. What is clear is that action must be taken to ensure the future stability of the financial system. With careful planning and decisive action, we can navigate these turbulent times and emerge stronger. The road ahead may be uncertain, but with vigilance and resilience, we can face the challenges and secure a stable financial future for all. Remember the days of ultra-low mortgage rates? It wasn't that long ago when homeowners were enjoying historically low rates. Millions of Americans rushed to refinance, locking in incredibly low monthly payments. It was a frenzy, a mad dash to secure the best possible deal. Banks, flush with cash from government stimulus packages, eagerly wrote these loans. They were more than happy to accommodate the surge in demand. It seemed like easy money. The economy was booming and everyone was optimistic. But what goes down must come up. The economic landscape is ever-changing and nothing stays the same forever. Fast forward to today, and the Federal Reserve is aggressively raising interest rates to combat inflation. The era of cheap money is over. These rate hikes have sent mortgage rates soaring. Home buyers and homeowners alike are feeling the pinch. The average 30-year fixed-rate mortgage has more than doubled in the past year. What was once affordable is now out of reach for many. This dramatic shift has created a perfect storm for banks holding those low-interest loans. The financial landscape is becoming increasingly turbulent. Why? Because those loans are now much less attractive to investors. The market dynamics have shifted dramatically. Who wants a 3% return when they can get 6% or more elsewhere? Investors are always looking for the best returns. This makes it harder for banks to sell these loans, forcing them to hold on to assets that are rapidly losing value. The unrealized losses mount. Banks are now facing a dilemma as they must navigate this new financial reality. Homeowners, too, are feeling the pressure. Those who didn't lock in low rates are now struggling with higher monthly payments. The housing market is cooling off, with fewer buyers able to afford homes at these elevated rates. The ripple effects are being felt across the economy. Analysts are warning of potential repercussions. The combination of high rates and economic uncertainty is a volatile mix. Families are having tough conversations about their financial futures. The dream of home ownership is becoming more elusive for many. Banks are reevaluating their strategies, trying to mitigate risks and adapt to the new environment. The road ahead is uncertain. As we navigate this mortgage rate roller coaster, one thing is clear: the financial landscape is shifting and everyone must adapt to survive. The problem extends beyond just mortgages. The quality of loans across the board is deteriorating. Businesses and consumers are feeling the pinch of inflation. Higher prices mean less disposable income, making it tougher to repay debts. We're already seeing the warning signs. Delinquency rates on credit cards, auto loans, and even commercial real estate loans are creeping upward. This trend is particularly concerning for banks, as it signals that those unrealized losses could soon become very real. Remember, banks make money by lending money. When borrowers default, banks lose. And when those losses are large enough, it can threaten the stability of the entire financial system. To make matters worse, banks are facing this threat with fewer shock absorbers in place. The financial landscape has shifted dramatically, and the safety nets that once provided stability are now framed. During the C-19 picnic, the Federal Reserve pumped trillions of dollars into the financial system. This unprecedented move was aimed at preventing a complete economic collapse and ensuring liquidity in the markets. This flood of liquidity allowed banks to bolster their reserves, acting as a cushion against potential losses. Banks were able to weather the storm thanks to the influx of capital that provided a much-needed buffer. But that cushion is shrinking. The once ample reserves are now dwindling, leaving banks in a precarious position. Banks are required to hold a certain percentage of their deposits in reserve. This regulatory measure is designed to ensure that banks can meet their obligations and maintain stability. As interest rates rise, banks need to hold more in reserve, leaving them with less capital to absorb potential losses on their investments. Higher interest rates mean higher reserve requirements, which strain the bank's ability to manage their portfolios effectively. This combination of shrinking reserves and mounting unrealized losses is a recipe for disaster. The financial health of banks is under threat, and the risk of a banking crisis looms large. It leaves banks vulnerable to even small economic shocks. Minor fluctuations in the economy can have outsized impacts on banks that are already stretched thin. And in today's uncertain environment, those shocks are becoming increasingly likely. The global economy is fraught with uncertainties, from geopolitical tensions to supply chain disruptions, making the financial system more fragile than ever before. The warning signs are flashing red. The parallels to the 2008 financial crisis are impossible to ignore. Back then, it was hidden losses on mortgage-backed securities that brought the financial system to its knees. Today, it's a broader range of assets, but the underlying dynamics are eerily similar. But this time, we have an advantage: hindsight. We know what happens when these problems are ignored. We know the devastating consequences for families, businesses, and the global economy. The question is, will we act on this knowledge? Will regulators take steps to address the growing risks in the banking system? Will banks themselves take proactive measures to mitigate their exposure? Or are we doomed to repeat the mistakes of the past?